From National Review headquarters in New York City, this is a Capital Writing author interview. Capital Writing is a project of National Review Capital Matters, and is part of our mission to explain, defend, and celebrate capitalism. Our guest today is Dr. Robert Hetzel. He was studied at the University of Chicago under Milton Friedman, then worked as a long time as an economist for the Federal Reserve Bank of Richmond, and is now a affiliated scholar with the Mercatus Center at George Mason University. His book is The Federal Reserve, A New History. Very simple title, very straightforward, and we're glad to have you with us.
Excellent.
All right, so you titled the book The Federal Reserve, A New History. What's wrong with the existing histories, and why do we need a new one?
Let me step back just a minute before I answer the question and talk about the general intellectual and political environment that makes such a update to the Friedman and Schwartz A Monetary History of the United States necessary. We lose historical perspective. As a society, we can't seem to learn the lessons of the past, no matter how dramatic they are. The world made extraordinary progress in the 19th century, led by Great Britain and its liberalism. The world moved toward free exchange of ideas, free movement of people, general movement toward free markets. All that ended with World War I. The world tried to put itself back together again. After the war, it was making progress, and sadly enough, as much as anything, the disastrous policy of the Federal Reserve System, which was highly deflationary and spread through the gold standard, brought the world economy down, and with it brought down the banking system. And because people associate capitalism with banks and the large bank intermediation, discredited capitalism, and we almost ended world civilization, Western civilization, in the first half of the 20th century. Now, in the second half of the 20th century, we did things basically right and resurrected Western civilization, and that had a lot to do with the creation of led by the Fed, of a modern central bank that initially, until it went badly off track in the 70s, provided a stable framework in which markets and capitalism could operate. But as part of restoring, world civilization, the United States led the movement toward a liberal, again, to resurrect the liberalism that existed before World War I. We moved toward free trade, free movement of peoples and ideas, and we were doing very well. Now, unfortunately, we seem to be going back in the other direction. The world is fragmenting into blocks. Now, primarily China and Russia are responsible for that. Their dictators have realized they can't create a society organized as a giant prison and also have free markets. So they've moved away from free markets. But the United States is not helping. The Democrats have lost the blue collar working man. To the Republicans, they want him back, but how are they trying to get him back? Well, through protectionism, through populist measures. The country spent a huge amount of effort trying to get rid of buy national, buy American. We're moving back toward that now, and central banks are not are not helping, particularly the Fed, with the Great Recession, which was not necessary, with the extraordinary intervention of the Fed now in credit markets and allocating credit that started with Ben Bernanke and has continued with Jerome Powell. Well, the Fed's aiding the movement back toward an interventionist, state-directed economy. So I feel very much that there's a need for a book in the spirit of Friedman and Schwartz to again revive the debate that we had in the 1970s between Keynesians and monetarists, and make the case for a stable monetary framework to enhance the ability of markets to work. Okay, that's sort of a. You got to understand, if you ask an economist a question, no matter how short and simple it is, you're going to get a long answer, and I'm no exception to that. Okay, so we can go back to your original question, or you maybe at this point our listeners have probably forgotten what the question was, so maybe you should ask it again, and then we can get going.
Well, I think you answered it. Just what is, why do we need a new history of the Fed? And that's why, because we didn't learn from the old history of the Fed, so we need a new one. I think you brought up the point about populism today. But obviously, populism has been around for a long time. It was certainly around at the creation of the Federal Reserve in the early 1900s, and you talk about that in the book. Can you speak a little bit to the role of populism in the creation of our central banking system?
So just to start with a little bit of background. The Fed was created in 1913 when the gold standard was in full operation. And with the gold standard, the supply of gold and the markets determine the behavior of the price level. It's not a responsibility of the central banks. The responsibility of the central bank is to maintain the dollar or pound parity of their currency, and then markets take over. And in fact, with that system, you had a long run. You did have instability, but you had a long run nominal anchor for the price level. The price level after the Napoleonic Wars was about the same as it was before World War II. Now, with the end of World War I, the gold flowed into initially flowed out, but flowed into the United States, and we had most of the world's monetary gold. And the Fed knew that if it allowed that to increase the money stock, that would create inflation. So the Fed did not follow the rules of the gold standard after World War I. It knew it was going to have to replace those with something else, and what it replaced them with was called real bills. That is the idea that the role of the central bank was to prevent speculative excess, the collapse of which was presumed to cause deflation and recession. Now, in the process, the Fed became a modern central bank. Well, what is a modern central bank? A modern central bank is a creator of fiat money through open market purchases, through bookkeeping purchases, through bookkeeping operations. Okay, now I'm finally going to get back to your question. Now you're probably surprised. So there was a populist tradition in the United States, personified by William Jennings Bryan and the agrarian interests who thought of the Eastern financial establishment, the big banks, as exploiting them through lending at high interest rates. And there have been, when the world went back to the international gold standard in the early 1870s, the world economy was growing. There wasn't a lot of gold production. There was a pretty steady deflation. Okay, so the Bryan people thought that if they changed the monetary standard sort of through the back door, through bimetallism, but basically they were going to create money. that would help their constituency, the agrarian farmers who had borrowed from the financial system, from the banks. Okay, now the Fed people didn't understand that they were responsible for the behavior of the price system with this new fiat money standard. Okay, and they didn't understand that. They really didn't even understand the idea of a banking system that whose deposits rested on the basis of the paper reserves that the Fed had created. Okay, the Fed still had this gold standard mentality, and they thought of the Bryan populace as the barbarians at the gate. They were going to come in and destroy the gold standard and destroy the Eastern financial system. And so why is that important? Well, it's important because in reality, the populists were right. When we were on a fiat money standard, we were responsible for money creation. We were responsible for maintaining the base of the reserves base of the banking system. But the Fed policymakers and, the Hoover and the rest, and even Roosevelt, they really didn't understand that responsibility. They thought the populists were going to, there had been monetary standards that were fiat money before, but they were all associated with monetizing government debt that provide revenue for the government. And for the Fed, the most recent example were the hyperinflations in Hungary, Germany, Austria. And so for the Fed to have understood that it was not the kind of central bank like the Reichsbank or the Bank of England that existed in the gold standard, was really something different. It was really a modern central bank that was responsible for the creation of fiat money. For it to have realized that and accepted the corollary that it was responsible for the price level, in their mind, that would have been crossing this chasm and giving in to the populist barbarians who wanted to destroy the financial system through inflation. Okay, several long answer, but
no, that was great. I mean, that's one of the things that that struck me the most about the history portion of your book is just thinking about that, and it's really the opposite of, or not, maybe not the opposite, but it's different than I think the conventional wisdom that people might have, because usually people will say, oh, the U.S. was on the gold standard until 1933 when Franklin Roosevelt did, or the U.S. was on the gold standard until the 70s when Richard Nixon changed that. But what you're saying is basically, no, the switch to fiat money happened much earlier, but the problem is that the Federal Reserve didn't realize that and didn't deal with it properly, and that helps explain a lot of the mistakes they made in the Great Depression.
Yeah, so that's important. It was a huge source of confusion at the end of the war and going into the 20s. The Fed had almost all of the world's monetary gold stocks. And so what we could do, even through the war, is to peg the price of gold. And in fact, it was a commodity stabilization scheme. We had all this gold. We could just run down or build up our gold reserves and peg the price of gold. But we weren't following the rules of the gold standard. We weren't allowing, we weren't changing the discount rate based on inflows and outflows of gold. So it looked like we were on the gold standard, and it looked like we had, the market would determine the price level. It wasn't the Fed's responsibility, but in fact, it was like a commodity stabilization scheme for wheat, where the government has a huge amount of wheat and can buy and sell to peg the price of gold. Anyways, it's sort of confusing. But let me say one other thing. You asked about why is this book important? The Fed wants you to believe that it's following the evolution of the economy, and it's always getting things right. And if something bad happens, there's this external shock that caused it, but the Fed's, doing the good fight. The way I like to put it is the Fed sees itself as an inflation fighter, not an inflation creator. Okay. Well, the issues that arise today are also echoes of the earlier issues. Now, sure, we understand some things better than we did in the 1920s. We're not going to let the banking system collapse. Okay. And we've got floating exchange rates. Our policies our bad policies aren't necessarily transmitted to other countries. Okay, so we've made some progress, but a lot of the issues we really haven't learned from. And I want to give you an example. I feel this. I used to visit Milton Friedman every once a year, and he was an incredible letter writer, and I've got bins and bins of his letters that I copied. And there was one very interesting exchange between him and the National Bureau. After he and Anna Schwartz finished the monetary history, it was a National Bureau project. They submitted it, and they got a very negative reaction from the National Bureau of Economic Research. The head guy there was somebody named Jeffrey Moore. He was the world's leading expert on the business cycle. He was a very preeminent economist. He and the directors were very much opposed to the Friedman and Schwartz monetary history. Why? Because they argued that the Great Depression was caused by speculation, especially in the housing market, and it was the collapse of that speculation that led to the Great Recession. And there's really nothing the Fed could do about it. Housing went through a boom. There was a collapse. There was a debt structure that supported an unsustainable level of economic activity, and there had to be this period of liquidation. Okay, well, think about today. Think about how people think about the Great Recession, and we could talk a lot about this, but sort of the standard newspaper story, which is, of course, encouraged by the Fed because it lets them off the hook, is that there was a housing boom. No question about that. They don't talk about the fact that the government tried to drastically increase the share of home ownership. But anyways, housing prices rose, and then they came down starting in 2007. And the story the Fed wants you to think about the Great Recession, which started in December 2007, that there was a housing collapse that interfered with financial intermediation because it impacted negatively the capital of banks, and so we needed the TARP, the Treasury Auction Recovery Program, and all these interventions in credit markets. Well, go back and think about the Great Recession. As a country, how did we deal with that? Well, through credit market interventions. We had Fannie Mae, we had the Reconstruction Finance Corporation, we had the Farm Credit Administration. It was viewed as a failure of the financial system. And as I said earlier, the public associates the large banks with capitalism, and the failure of the banking system was carried over to the presumed failure of capitalism. Well, doesn't that sound a lot like what we went through recently in the fall of 2008, when it became clear that the world was in a recession? I argue from contractionary monetary policy. We can talk about that later. The Fed reinvented itself as a combination central bank GSE. It was Fannie Fed. Well, even in this earlier period, the Fed was very concerned about separating monetary policy, even though it got it wrong, from credit policy, and it insisted that the banks be helped, say, with the Reconstruction Finance Corporation, which was financed separately from the Fed. Well, we didn't even have that kind of constraint starting in the fall of 2008. And so we became very involved in credit markets. And then after the March of 2020 and the pandemic, the Fed put that on steroids. We were even taking the tail risk of corporate bonds. Anyway, so the general point is that a lot of these issues recur, and we still go back and reinvent the same sort of myths as we did earlier. So there's a need for a history that can explain how these issues recur and how we need to learn from the earlier experience, rather than just thinking, oh yeah, well, that was 100 years ago. We're a lot smarter than those guys. We have nothing to learn. Well, the reality is we have a lot to learn. And getting back to the original point, we have a lot to learn about the importance of a liberal world order and a monetary system that supports free markets rather than kind of overrides them.
One of those other myths that you talk about in the book at the time of the Fed's creation was the idea that recessions, or panics as they used to call them, were caused by excessive speculation, that the job of the Federal Reserve, part of its job, and really one of its primary purposes when it was started, was to curb excessive speculation. Whereas now we have a much different understanding of macroeconomics about what causes recessions. And while we don't have any unified theory that explains all recessions, we have a little bit better than just the idea of people are speculating too much. So what was the practical impact on the Fed's actions from this mistaken belief about the cause of recessions?
Well, okay. Let's talk about that, and let's also relate it to more recent policy. If you go back to the post World War I period, the Fed set off a recession in 1920 because it saw all this inflation. Inflation came from monetizing government debt in World War I, but the Fed assumed that it was a speculative inflation. It didn't think it had anything to do with inflation, and so it set off a recession by restricting the supply of bank credit. Okay, well, that lowered the prices of commodities, and that set the populace on fire. From Nebraska and Iowa and so on. And the Fed so commodity prices fell drastically, the price of corn and wheat. And so the Fed came very close to losing its independence at that time, which had only been given to it by the Treasury in 1919. So the Fed drew the lesson: we got to prevent this speculative excess so that we don't go through this in the future. So that's what it was focused on. And when the stock market boomed in 1926, 27, 28, and early 29, they said, here we go again. Here's the speculative excess. People are going to create this credit structure, which is a house of cards. It's going to collapse. We're going to have a recession. We got to squelch it. We got to get on top of it. So the Fed implemented a very contractionary monetary policy, and the credit structure of the banking system contracted, and that set off the Great Depression. Okay, but let's go back to let's come back to more recent history. There's a very interesting quotation by Ben Bernanke, who was at the 90th birthday party of Milton Friedman at the University of Chicago. He said, Anna and Milton, we're sorry, we get it. It was the Great Depression, but thanks to you, we won't do it again. Well, Friedman and Schwartz emphasized that this Great Depression contraction in bank credit caused a contraction in money. and it was the contraction in money that caused the deflation and the instability, the decline in output, decline in the money stock of almost a third. Okay, well, but Ben Bernanke made his reputation by starting with this contraction of credit, but ignoring the Friedman and Schwartz emphasis on money and emphasizing what he called the credit channel. That really what caused the Great Depression to be so deep and so long was an interruption with financial intermediation. Okay, now jump to fall of 2008. My book argues that there was a decline in the natural rate of interest. That's jargon, but the natural rate of interest is the real rate of interest that distributes demand over time to keep aggregate demand at potential, so to maintain full employment. That's how the price system works. Okay, well, this natural rate of interest was declining, but policymakers didn't understand that at the time. They went into summer and fall of 2008 focused on high inflation that was caused by a giant inflation shock, okay, from China joining the world economy and increasing the demand for copper and iron and so on. Okay, so in the fall of 2008, it becomes obvious that the world is in recession, serious recession, that actually had started in the summer of 2008, and that's important because that's before Lehman. We'll come back to that. But Lehman is in September 15th, 2008. Okay, and up to that point, the cash investors have been willing to finance the dodgy mortgage portfolios of Goldman Sachs and Lehman and Bear Stearns and so on, because they felt confident the Fed would bail these institutions out. It wasn't so much too big to fail; it was too indebted to fail. And when the Fed let Lehman fail in September, these cash investors jumped to the too big to fail banks like Morgan, J.P. Morgan Chase. Okay, so there was a disruption to the financial system, but the Fed, the Fed thought, oh, monetary policy is just fine. We got a 2% interest rate, we got underlying inflation at 2%. We're concerned that expectations will kind of rise and give us higher inflation. So the Fed stayed focused on inflation. It was unwilling to lower the funds rate, which it should have done. And Bernanke, given this background of studying the Great Depression and believing that the Great Depression was caused by a disruption to financial intermediation, well, it was just obvious to him that the problem was not monetary policy. For goodness sakes, a policymaker would never admit that he's making a mistake. That's not going to happen. Okay, we're all human. I'm just as human as he is. Okay, I would have done the same thing. But, the Bernanke FOMC, there's no way it could admit that monetary policy was contractionary. It didn't understand that that it really needed these tools that would develop later on, like QE and forward guidance to deal with a negative natural rate of interest. So the Bernanke FOMC thought, the problem is that there's this disruption to financial intermediation. So we got to get involved in the credit markets. And so Bernanke gave this famous speech I don't know if it's famous, but anyways, in London in early 2009. He said, monetary policy is not about the liability side of the banking system. That is about the monetary base and money creation. It's about the asset side and how we allocate credit through our balance sheet to offset the flight of cash investors from the from the investment banks and so on. It's all about how we allocate credit based on the kinds of assets we put on the balance sheet. So, as I said earlier, the Fed reinvented itself as a combination central bank GSE. I think, as a matter of political economy, that's a disaster because it leads to heavy involvement of the central bank in issues that are basically political, having to do with the distribution of allocation of resources and so on. And what the Fed should have done in the fall of 2008 said, "Oh my God, we got to maintain aggregate demand. We got to start buying long-term treasuries like mad to create money beyond what was being created by the inflow of funds and the too big to fail banks, and maintain aggregate demand." Now, it was, as I said, it was very worried about high inflation and losing its credibility for low inflation. What it should have done was to announce an inflation target to give itself credibility. It didn't do that until January 2012. Okay, almost four years later, and then been aggressive about quantitative easing and maintaining enough money creation to maintain aggregate demand. And I won't get into this, but there were very different ways to deal with the disruption to financial markets, in particular the way we did with Penn Central in 1970, which did not involve going out and buying commercial paper ourselves.
So what the Fed did in 2008, getting involved in credit markets, it then did that, but way more in response to the COVID pandemic, right?
Yeah, that's one of the problems with not having an articulated strategy or rule that is based on an articulation of the monetary standard. The monetary policy can change based on the composition of the whoever's on the FOMC and on their worldview. And it just so happened in March of 2020, the Fed was very Keynesian and led by Chair Powell, Leo Brainerd, presidents like Mary Daly at the San Francisco Fed. The Fed began to see itself as very socially conscious, as having a responsibility to maintain an unemployment rate low enough to maintain full employment in minority communities. And so with the pandemic, all of a sudden, restaurants couldn't offer sanitary meals, and people started eating at home rather than going out. Well, there was a lot of people were laid off. In April of 2020, the unemployment rate jumped up to 14.7%, and it was a productivity shock. You could put all the money, you could stuff people's pockets with money, but they were not going to go out to a restaurant. That was not the solution. But the Keynesian Fed saw this as an opportunity to increase aggregate demand. Before the pandemic, unemployment rate had been 3.5%. You'd have basic price stability, inflation of around 1.5%. So the Keynesian Fed, Phillips curve and this stuff about trading off between inflation and unemployment. Well, the Phillips curve is flat. We can push unemployment down at least to 3.5% without inflation. And we had recoveries before in the 90s and in the 80s where markets were allowed to work and the unemployment rate declined steadily to a quite low rate, but the Keynesian Fed that would take way too long. We're really going to step on the gas pedal and bring inflation down much more rapidly than that we have this social responsibility for minority unemployment and so on. There's no way we can just sort of take our time and let markets work and bring unemployment rate down. Well, okay, so we got the most expansionary monetary policy we had since the 1970s, and guess what? Long before unemployment rate got to 3.5%, we got inflation. Milton Friedman would not have been surprised.
Yeah, with the post-COVID monetary policy, you talk in the book earlier about the idea of lean against the wind, and which came from William McChesney Martin, who was the chairman for a long time. The thought process of the Federal Reserve at this time, like you said, seemed to be, well, the economy's doing bad, so we got to lean against the wind, and we got to lean really, really hard because the pandemic is going to be really, really bad for the economy. But why was that not the right way to think about it?
Okay, so let's step back a minute. William McChesney. So after the Treasury-Fed Accord in March of 1951, the Fed had to invent itself as a central bank. It hadn't had independence since March of 1933, when the Roosevelt administration came in, and then there was an explicit peg on long-term interest rates in World War II, which was continued into the start of the Korean War. Now, the real bills philosophy implied that because in World War II, the credit structure rested on something other than these real bills, paper used to finance goods in the process of production. It rested on government securities. There would be an inevitable collapse, and the world would go back into the Great Depression. Well, that didn't happen. Real bills disappeared, so the Fed had to reinvent itself. And the way Martin and his assistant Winfield Reefer did that was to focus on the whether the economy was growing too fast or too slow. It was growing too fast if rates of resource utilization were persistently declining, and the Fed would then have to raise interest rates to maintain steady the economy's rate of resource utilization. And note that does not imply choosing a target for low unemployment. Keeping the economy growing along its potential path, as evidenced by stability in the economy's rate of resource utilization, meant that the economy was growing to potential, and the economy was churning out the unemployment rate consistent with the full employment of resources. Okay, now that's the basic framework that Martin started, but it's been implemented in two very different ways, which have created two very different monetary standards. Okay. Now, again, getting back to what we said initially, the Fed just says, oh, yeah, the economy evolves. We understand that evolution on an ongoing way, we'll just adjust policy and do the right thing. Well, I mean, that, and then they repeat the mantra, we pursue maximum employment and price stability. Well, that's just a profession of good intentions. It doesn't really tell you anything about what the monetary standard is. And in fact, in the post-accord period, we pursued two very different monetary standards, starting with lean against the wind. There's the version that Martin moved toward, and that was recreated by Volcker and Greenspan, in which which was based on preemptive increases in the funds rate to preserve price stability. Okay, but then there's the aggressive policy of trying to add to price stability low unemployment. And so when you have an economic recovery, the Fed sort of lays off raising the funds rate. It sets aside preemptive increases in inflation in the funds rate until it actually gets inflation. Okay, so you have this earlier policy that basically allows interest rates to adjust to keep output growing at potential without trying to fine tune or manage or set an independent goal for a socially desirable low unemployment rate. But you also have this other version, which kind of raged, it came into full force in the 1970s, in which the Fed has this independent target for low unemployment. And when it's focused on that, it keeps the funds rate down until you actually see inflation. So the difference between these two policies is whether you're willing to, in terms of this lean against the wind procedure, engage in preemptive increases in the funds rate to preserve price stability, or whether you wait until you see inflation. Well, as a consequence of trying to restore the nominal anchor, the expectation of price stability that was lost with the fine-tuning policies in the 1970s, Volcker and Greenspan moved toward a policy of restoring price stability, and that disciplined them to engage in these preemptive increases in the funds rate. And if they didn't, they had the bond market vigilantes there who had been burned very badly in the 70s to make sure they did, okay? And so then we talked about the Great Recession. But, basically Yellen followed this earlier policy. There was remarkable stability in underlying inflation in the recovery from the Great Recession. Inflation's personal consumption expenditure inflation stayed around 1.5%. We basically had price stability, okay? And so Yellen maintained that by increasing the funds rate starting in December 2015 and then more aggressively in December 2016. So she was actually following these earlier great moderation monetary policy of Volcker and Greenspan. But then when you come to the pandemic and you come to the sharp rise in unemployment, and you got Rich Clarida, Powell is not an economist, so he can't make these policies up. But Clarida, who's sort of arch Keynesian, was there, and he did. And so you jump back to this 1970s policies of having two independent targets, rather than having one target for price stability and letting a healthy economy churn out maximum employment, low unemployment. You have these two independent targets, which you juggle, and juggling these two independent targets takes you down this path of Keynesian aggregate demand management, Phillips curves. You got to have some way of predicting the relationship between unemployment and inflation, and that's the Phillips curve. And if you're balancing off inflation and unemployment, which is basically slack in the economy, the amount of slack in the economy, then you have to have a non-monetary view of inflation. Inflation doesn't come from the Fed; it comes from these supply shocks and the monopoly power of corporations and labor unions. And how many times have your friends told you that the price increases we're seeing out there are due to the greed of corporations? How many times have you heard that? So we went back to these earlier policies of aggregate demand management. Look, when you're trying to juggle these two targets, sometimes you're worried about low unemployment, so you want to step on the accelerator. And then other times you're worried about inflation, so you want to step on the brake. And the The Keynesian view is that you really can juggle these two balls. You can balance them off in a predictable way. Milton Friedman said, the problem is long and variable lags, because if you pursue an expansionary monetary policy, you're going to get inflation, but you won't see it for a long time. So you step on the accelerator too hard. And then when you see inflation and you step on the brake, it's a long time before inflation comes down, and then you step on it too hard. So right now, who knows where we are? Chair Powell has realized that central bankers don't get into central banker Valhalla if they go out with inflation. So he's going to bring us back to 2%. But what happens when you get disinflation? And the Fed will create disinflation. It just has to keep pushing interest rates up. What happens when you get disinflation? The inflation's coming down, but the unemployment rate is coming up. What's the Fed going to do then? Is it going to restart this whole go-stop cycle? Is it going to go back to the Volcker-Greenspan policy of concentrating on price stability? We don't know, because the Fed doesn't tell us. The Fed gives us forward guidance, but forward guidance is not a substitute for a explicit strategy that carries through beyond particular time periods. The Fed's not giving us that. So, okay, the inflation rate will come down, but as it comes down, what's to make it stop at 2%? Well, we don't know. The Fed's not told us. Okay, and if somehow miraculously it does stop at 2%, how is the Fed going to keep it there? The Fed, we need a strategy. Economists used to talk about a rule. Okay, now, and then the Fed says, "Oh my God, mechanical rule." Well, rules are going to involve some judgment, but they need some long run discipline, like we talked about at the very beginning. The gold standard, with all its problems, provided a long run stability to the price level. Well, we don't have the gold standard now. What's going to provide that long run stability to the price to the price level? The Fed's got to have some procedures for controlling money creation for that to happen. Look, what we did starting in March of 2008, we monetized a very large fraction of the three pandemic transfer payments that the Fed made to the public. And sure, Chair Powell says money has nothing to do with inflation. Somehow or other, the United States is immune from the laws of economics that bedevil Zimbabwe and Venezuela and Argentina. Now, sure, there's a difference in degree, but there's not a difference in kind. If you're going to monetize government debt beyond the requirements to provide currency for seniorage, you're going to get inflation somehow. And this gets back to the need for a history. We go through all these painful experiences. We had 12% inflation at the end of the 70s. Well, that was because money growth was too high. Well, somehow or other, that's irrelevant policy today. Read my book.
So the Fed sort of attempted to try to say what it was going to do when it announced the flexible average inflation targeting with 2%, and it basically said, we're gonna have an average of 2%, and we're gonna go after both overcorrections and undercorrections, and we're gonna try to keep 2% average over time. Now, the problem with that is they never said how long a time they're averaging it over. And then now, after the fact, they've said, well, we're not going to correct the under, we're not going to go under 2% to try to do that. And so they've sort of lost the plot of that attempt to say what their strategy was. What should they be saying now about what their strategy should be so that we can actually get back to low and stable inflation like we had for 40 years until recently?
Yeah, well, that's a great question. I'm going to come back to it, but let me comment on flexible average inflation targeting. That was to a significant extent opportunistic. That is, the funds rate had been was at the zero lower bound in March of 2020. The Fed had pushed it there. It wanted monetary policy to be even more expansionary. That's why it was buying all these Treasury and MBS mortgage-backed securities. Okay, well, it didn't want it didn't want bond rates to rise. It wanted to keep bond rates low, and so basically, it told the markets two things. We're going to abandon preemptive increases in the funds rate. We're just going to keep the funds rate lower for longer, and that's what gave that's what made the debt monetization into helicopter money. Okay, and the second thing it told markets is that when the inflation rate starts rising, we're not going to raise the funds rate. So don't get worried, don't get nervous. Just don't raise bond rates. It didn't want a May of it didn't want the May of 2012 increase in bond rates when we abandoned QE. Okay, so so flexible average inflation targeting. That was a way of telling the bond markets, don't worry, when inflation starts rising, it's going to be a temporary thing and we'll bring it back down to 2%. Well, what it didn't articulate was that flexible meant that it was not going to be symmetric. We would let inflation rise, but we weren't going to let it fall beneath the 2% target. That all came from the social consciousness and wanting to keep unemployment rates low, and so on. Flexible meant flexible one way, not two ways. And that was all part of this Odyssean forward guidance of trying to convince bond markets that we were going to keep the funds rate low for a long time until we got at least back to 3.5% unemployment. Well, as we've been talking about, we got a monetary policy that was the most expansionary that we had seen since the 1970s. Now think about it for a minute. A central bank committing to raise inflation. How often do you see that? Okay, so we need some kind of long-run stable nominal anchor. It's not going to be the gold standard, of course. And we could have had that nominal anchor through Milton Friedman's stable money growth rule, but in the early 1980s, with technological innovation that made it real easy to transfer between bank deposits, like certificates of deposits and so on, and money market instruments, you began to get this intermediation and disintermediation into bank deposits that was caused when market rates changed and banks were slow to raise their or change their deposits. Like right now, the average rate on bank deposits is 1/3%, and you can get 5% in a money market fund. So that creates these incentives to move funds back and forth that distorts the ability of the monetary aggregates to be an accurate measure of liquidity of the public's asset portfolio. So the Friedman's steady money growth rule is not going to work either. And so what I'm arguing is that if you're going to have 2% inflation or whatever the inflation rate is, you've got to maintain a difference between the growth in dollar demand and the growth in potential output. If potential output is growing at 1.5%, then the dollar spending of the public, if you're going to have 2% inflation, is going to have to grow at 3.5%. So we should have the Fed should be explicit, and it should now announce a benchmark path for nominal output growth. I use the final sales to private domestic purchasers as my preferred measure, and commit to maintaining a 2% difference with potential output growth. And as potential output growth fluctuates, it can adjust that potential. If output growth goes to 3%, potential output growth goes from 1.5% to 2%. Well, you raise the benchmark path by 1.5%. But you have a long run discipline. You've committed yourself. The public can see it. The public can hold you accountable for that over time. But the Fed doesn't want to take responsibility for the growth of aggregate dollar demand. But that's what it needs to do. Because if you're going to have 2% inflation, you've got to maintain that difference over time. And the Fed should commit to that kind of policy and be willing to offer consensus forecasts that are aligned with that benchmark path. So that's my proposal.
Yeah, that's good. I have one last question for you, and that is about a post that Scott Sumner wrote, another Fed scholar and a contributor to National Review, actually, recently, in an article about the Federal Reserve. And he wrote this post giving you the title, "The Man Who Was Right," because you, both times in 2008, 2009, when there was a lot of concern about inflation, you said that inflation would not go up, and then in 2020, after the pandemic, you were one of the ones who was warning that inflation would go up, and you were right both times. And a lot of people are batting 500 on that, but you got both of them right, which I think says a lot about the wisdom of your approach to monetary policy. But how was it that you were able to get that right both times, saying no inflation in 2008, 2009, and yes inflation in 2020?
Well, you've got to look beyond the Fed rhetoric, the Fed boilerplate. The Fed is always going to tell you it's addressing the economy's most pressing problem, whether it's we need lower unemployment or whether we need lower inflation. You got to look through to the implicit strategy that the Fed's following, and whether that provides a stable nominal anchor by tying down the expectations of the public, and then allows the price system to operate in such a way that the central bank indirectly controls money creation. And so, I was looking at the underlying strategy of monetary policy and using the historical experience of the 1970s and the Volcker-Greenspan Great Moderation, and using that to try to understand the consequences of the shift in policy, but in the shift in the underlying strategy. But that's the great problem. That's why we need to write books on the Fed, so we gain some understanding, some real sense of what kind of strategy the Fed should follow to provide a stable framework in which a free market economy can flourish.
That's great. That's a great way to end. Thank you so much. Robert Hetzel, the author of the book, The Federal Reserve, A New History. It's a beast. It's a really big book. It's around 700 pages, lots of primary source material. He goes back through archives of correspondence and congressional testimony and all these different things. So you've got to be pretty interested in the Fed in order for this to be a good book. But if you are interested in the Fed, and I think a lot of our readers and viewers are, it is certainly worth digging into. And Dr. Hetzel's expertise is unmatched.
To paraphrase George Bush, read my lips, read my book.
There you go. All right. Well, thank you so much.
My pleasure. Thanks.